So it seems like everybody has a story about how they lost money in the stock market, or they have an uncle or a brother or a friend who lost a ton of money and they swear by it and they say, oh, the stock market is a losing game. Nobody ever makes money in the stock market. Well, in my opinion, that is just not true. A lot of people lose money in the stock market. In fact, most people do. Most people who get involved in the stock market lose money. And that's the unfortunate truth. But what I want to give you guys today are the 5 reasons why most people end up losing money in the stock market. So what I want to ask you to do, if you know somebody who lost money in the stock market, before you just take their opinion and say, okay, the stock market is a good way to lose money, I want you to figure out what it is that they did, how they decided on their investment. And if they did one of these things I have listed here, maybe you'll begin to understand why it is they lost money in the stock market. And if you can avoid doing these 5 things, you can make money in the stock market. But these are the 5 things that are most common when people lose money in the stock market. They generally did one of these things or a combination of these things. Number 1 is either overexposing yourself or having inadequate diversification. I'm sure if you talk to anybody about the stock market and they know what they're talking about, they're going to tell you to diversify. So don't put all of your eggs in one basket. Unfortunately, a lot of people do exactly this. They put all of their eggs in one basket, and people will go all in on one stock or one particular market or one industry as a whole. The problem being when that stock or that industry or that particular market goes to shit, their whole investment goes down. Whereas if you had diversity and you had many different investments, maybe one of your investments goes bad, but the other ones are fine because they're not affected by that. Here's an example of this. So most people working for Enron put their entire pension in Enron stock. And we all know what happened to Enron. People lost a ton of money, and some people lost their entire pension by having all of their money invested in that company. They were not diversified. So if people are not diversified and they're solely investing in one industry or one stock, you can lose all of your money or lose a ton of money. Another example of this is people will invest solely in small or large cap stocks. And in most cases, it's good to have a blend of these. If you're invested in any kind of fund, you want a blend of small cap and large cap stocks. What people end up doing, because this is like the biggest thing I see with the stock market, and just with my friends that I talk to about stock market, they all are asking me like, hey, how do I like triple my money? How do I double my money in the stock market? And if I told them, okay, well, make good investments and expect like 20% return a year, and maybe in 5 years you double your money, they're going to be like, well, that's not very exciting at all. They're not interested. So anybody looking to like double or triple their money, they're looking to take these high risk bets. And these are the people who end up losing a lot of money, or they lose all of their money because they're looking for unrealistic returns from the stock market. In order to double or triple your money, you're generally making a high risk investment. And when people make these investments and they go the wrong direction, this is when they lose their shirt and they end up just getting out of the stocks and they just say, okay, it's a losing game. But if you're somebody who's looking for consistent, 10, 20% returns somewhere around there per year, that's easily doable, and you can diversify and not have as much risk. But if you're somebody looking for these unrealistic returns, you're going to be making these high risk investments, and a lot of people lose money by doing this. Another thing people do is they invest solely in stocks, and especially with your 401k, you should have a blend of stocks and bonds. A lot of people have automatic, basically every 5 years, I know I have this set up with my 401k, but where every 5 years it automatically changes the structure of it. So right now, because I'm younger, obviously I'm not retiring anytime soon. I won't be able to touch that money until I'm, I think it's 59 and a half anyway, maybe it's more than that, but I got like basically almost 40 years for that to build over time. So right now, because I'm young, I'm more involved in stocks and less involved in bonds. But as I get closer to retirement, that diversification changes, and I have more in bonds and less in stock, because you're not looking to risk your money the closer you are to retirement. A lot of people make the mistake of having their entire 401k or their entire portfolio strictly in stocks, and when the stocks go bad, when we're in a bad market, they lose a ton of money. So you need to have diversity, between stocks and bonds as well, and maybe even, certificates of deposit or whatever. There's other ways you can do this, but most people are solely involved in stocks, and that can be a problem as well. A general rule of thumb that I've always come across when doing my research is that, you want to have a diversified portfolio with no more than 25% of your portfolio in any one particular thing. So you would never want to take every penny that you had and put it in one investment, because that's one bet. And if that bet goes against you, you've lost a ton of money. So that's generally the rule of thumb I follow. I've never invested all of my money in any one thing. I have investments in many different areas. And as a result, even if I lose money on one thing, you're not losing money on the other thing, and it kind of offsets the losses. But when you're all in one basket, you have the potential to lose a lot. And just a general rule of thumb, guys, too, people who are looking for a high return, generally investments that have the potential to give you a high return are high risk investments, or higher risk than investments that could give you a 10 to 20% return, something like that, that's more realistic. So number 2, people invest based off of tips, newsletters, or the hot stocks that are mailed to you. This is the biggest problem I see. And what this stems from is this: believe it or not, people want to be able to blame someone else when their investment goes sour. So when they lose a ton of money, they want to be able to say, oh, I'm not going to mention anybody's name, but we'll say Jim gave somebody stock advice, and Jim said, this stock has unlimited potential, you need to invest every penny you have in this stock. And then we find out that Jim was wrong. And then that way they can go, oh, Jim is an asshole. I lost a ton of money because Jim told me to buy this stock, and that's why I lost money. It's harder to say, okay, I, did my research, I liked this company, and I was wrong. It's harder to say that because then the blame's on you. But you need to take responsibility of your own investments. Do your own research, find a strategy that works for you, and stick to it. That's another thing people do. They bounce around with different stock trading strategies. One day they're buying penny stocks, the next they're buying, it's just you need to stick to a strategy that works for you. Maybe you buy stocks based on fundamentals, and you're looking to hold stocks for multiple years. Or maybe you're a short-term trader and you're holding stocks for a couple of days. Maybe you're a day trader and you're trading in and out every single day. Find a strategy that works for you and stick to that strategy. Don't worry about what anybody else is doing, and don't allow other people to influence your decision. If you've made an investment based on your own research and you put your work in, own that investment, have some confidence in it, and don't let other people tell you what to do with your money. It's your money at the end of the day. So do not invest based off of tips or research or any of those hot stocks newsletters you see going around. Number 3, this is kind of multiple things fall under this, but I just wanted to throw all of these out there. The first thing is people will hold on to a losing stock, or they do what's even worse, which is called averaging down. Or on the other hand, sometimes they get excited and they sell too quickly, and I've done this too. So it's something a lot of people do, as far as they selling too quickly. I've never averaged down, I'm happy to say that. I know a lot of people who have, and the strategy makes sense in your mind, but it's just a losing bet because the stock's already losing. Why would you want to put more money into a falling stock? So most people end up clinging to a losing position where they just hold on to it because they're like, oh, I've lost all this money. I'm afraid I'm going to lose even more. And it depends. I mean, if the whole market is performing badly, then you may want to hold on to those stocks depending on what the company is. But if the company has poor fundamentals and it was a bad investment, it may be time to just cut your losses on it. But what's worse is a lot of people do what's called averaging down. And when you average down, what you're essentially doing is you're going to buy more of a losing position in order to lower the average price paid per share. Just for example's sake, let's say you bought 10 shares of a stock at $20 a share. It fell to $10 a share and you bought 10 more shares of that stock. Now your average price paid per share is $15. So you say, okay, all I need to do is have that stock come up to $15 and I can get my money back out of it. That is a losing bet, guys. If you're down, don't buy more of that stock. It's a losing bet in most cases. I've never really known anybody who successfully was losing on a stock, decided to buy more to average down, and ended up making their money back or making any money in the long run. Maybe there's a couple anomalies where people actually did that, but I've yet to come across or talk to anybody who's had success with that trading strategy. What you should be doing, and this is just my opinion because I trade based off a technical stock analysis. I follow stock charts for the most part. I do pay attention to fundamentals of companies, but I generally am trading in a shorter term. I'm not holding for long durations for the most part. I do have a couple of stocks that I have a position trade on where I'm holding it for a long duration. But for the most part, I trade swing trades where I'm looking at basically short-term holds based on charts and data. So what I do is, if I make an investment, I'll set an actual stop point based on the actual charts of the stock, based on technical stock analysis. And in most cases too, I'll set a trailing stop too, where if it falls a certain percentage or falls a certain dollar amount, it will automatically sell. That way I know how much I'm risking on this investment. I'm not just letting it free fall and waking up one day, checking my stocks and saying, oh, look at that, I'm down 30%. I would set it where, hopefully it would sell as long as it fell during trading hours and didn't just gap down. You generally would be able to, set a level of risk that you're comfortable with. That's what I do anyway. So like I said, if the stock is falling and the company has bad fundamentals, just dump the stock and take the tax loss on it and call it a day, and make another investment another day. Hopefully you do better research next time. Hopefully you learn something from this investment. This is a quote too that I really liked. I don't remember where I came across this, but it said, bad short-term investments turn into long-term investments. And it's true. I know a lot of people who made a short-term investment and they ended up just holding on to it because they lost a ton of money. I still have a long-term investment in a biotech company I bought over a year ago. It had fallen drastically, and I was like, well, it can't possibly fall anymore. Bought some shares of it. I didn't invest a ton of money into it, and the stock fell like even more from there. I bought it at $8.90 a share. I think it fell to just about $2 a share shortly after there, so I was way down on that investment, and I'm still holding on to it. Here I am, a long-term investor in this company that has bad fundamentals, and it's like, why did I do that? But that's why I'm a long-term investor, because I made a bad short-term investment in that stock. I'm still thinking at some point it may come up, but just on principle, I just decided to hold on to that stock to see if it will come up. I don't have a ton of money invested in it. Then on the other hand, a lot of people end up selling too quickly. That's because they get excited when their investment is up, and often they sell too soon. And this is tough because there's a fine line between selling too early and then being greedy and riding a winner into a loser. You don't want to do either one. You kind of want to be somewhere in the middle. So the general rule of thumb that I always follow is never sell a rising stock. If that stock is in a healthy uptrend and it seems to be going nowhere but up, until you see a reason to sell, maybe you see it starting to level off, maybe you're seeing a sell-off based on volume, that is a sign that, okay, maybe it's time to sell the stock. But if the stock is flying, keep that stock and, take as much money from that position as you can from that investment. Now, a lot of people, you get excited. You're like, okay, wow, I've made some money here. I want to make sure I don't lose it. So they sell. Next thing you know, the stock is up even more in the next couple days or next couple weeks. And you're kicking yourself saying, why did I sell? So, and I've done this myself too. I've sold rising stocks and I made money on them, but I left a lot of money on the table. So you kind of want to, have a little bit of discipline with that and say, okay, if the stock is rising, I'm not going to sell it. But if I do see that if I do see signs of a sell-off, or I do see that it's reaching a peak, that's when I'm going to sell. On the other hand, do not be greedy and ride a winner into a loser, because it is better to sell when you can, not when you have to. You never want the stock market to be in control of you. You want to be in control of your own investment and say, okay, I'm happy with this profit. I'm going to sell because I want to. You don't ever want to be forced to sell. Okay, so the fourth reason why people tend to lose money in the stock market is because they will chase a stock. This is when a stock is way up and people decide to buy it when it is on its way up. And this makes sense because that's generally when the news headlines hit that this stock is performing so well. People buy high. And the general idea with a stock, the idea is to buy low and sell high. I know if you ask most people flat out, hey, can I have some stock market advice? A lot of people will say to you, oh, you should buy low and sell high. And a lot of the times you think that they're mocking you because it's like, well, everybody knows that. But it's funny because so few people actually follow that rule. What they end up doing is buying a stock that is way up, and then people sell off, the stock goes into a sell-off, and investors take a profit, and then the stock price falls soon after. So if a stock is way up, it may be heading into uncharted territories without a support to fall back on. I'm not going to get into it in this video because I don't want to drag it out any longer. This is just kind of a quick video here. I mean, as quick as it can be. It's probably going to be 15 or 20 minutes. That seems like the general rule of thumb with all my videos. They end up being like 15 or 20 minutes. But if you know what, you guys who stick around for the whole video, I do appreciate you, because I know sometimes I have the tendency to ramble on a little bit. But look up support and resistance areas for stocks to understand how that works. When a stock is way up, it generally does not have a support area to fall back on. So it's in uncharted territories. Ideally, you would have invested in the stock when it broke out of a base. And people generally get pissed off and say, oh, you know, I missed out on it, I better get in on it anyway. And so, in some cases you're lucky. If you buy a stock that's way up, you can have luck with it. But don't buy something just because it's on its way up. You know, other opportunities will come along. So just, you know, say, okay, maybe you had your eye on that stock and then it went up and you didn't buy it. Say, well, I guess I'll trust my gut next time and invest when it's in a basing period. You don't generally want to buy stocks when they're in a heavy uptrend. I know I didn't follow my own rule here, because I just recently invested my money back into AMD, some of the money that I have in my trading account. And a lot of people have called me out on that, because they're like, hey, you know, you're always telling people to buy when it's in a basing period, and I bought during an uptrend. But I bought based off of the earnings report, and I also have had success with that stock already last year. So I had a couple reasons to kind of break my own rule. Maybe I'm wrong and I'm going to get taught a lesson. We'll find out, and obviously I'm going to share my experience with that stock with you guys just so we can learn from it. But I just wanted to point that out, because I was thinking somebody might hear me say that, and if you watch that other video, you would say, hey, didn't you just buy a stock that was way the hell up? And I would be like, yes, I did. But, you know, I understand the risk involved with that. A running stock can be dangerous if investors are eager to sell and take profits. And generally speaking, the steeper an uptrend is, the riskier it is, because more investors are going to be looking to take profits and, you know, get what they want out of that stock. And when they're going into a sell-off, that stock can come way back down, and in many cases go even lower than it was before. So your best strategy is to either wait for another opportunity, or at least wait for that stock to pull back to a support area, so you know there's an actual support for that stock and it's not just hanging out there in uncharted territories. So look up support and resistance areas for a stock if you want to understand more about that. That's kind of what I'm talking about here. Number 5, this is the biggest one, and it just frustrates me so much how many people out there are pushing this crap on investors. Watch the movie Wolf of Wall Street if you want to understand what was going on with this back in, I believe that was the 1980s, where they were pushing penny stocks on investors with they were making huge amounts on commission, giving people these terrible stocks, getting people to invest in penny stocks. I don't know what the allure is with penny stocks. It's like everybody wants to buy this stuff, and a lot of it's absolute crap. I've never invested in a penny stock. I've invested in stocks that were trading. Let me just throw this out there too, in case you don't understand this. A lot of people don't realize this, but a penny stock is defined by the SEC as a stock that trades under $5 a share. Most people would think it was a stock that trades for under $1 a share, but actually any stock under $5 a share is considered a penny stock. Most people just love the idea of investing in something and seeing that stock quadruple in value and making a ton of money. And some people have luck with that, but the reason I have this in quotes is because I don't even see penny stocks as an investment. I think it's a freaking gamble. So I would almost call this gambling in penny stocks. So penny stocks can be a very dangerous investment, and that's for a couple of reasons. Most of these companies are not profitable, and as a result, there's a much higher risk of them going bankrupt. If a stock goes bankrupt, you'll be lucky if you see any of your money, because you're probably going to be one of the last people to get paid when all the money is settled in the end. So when you're investing in a penny stock in a company that's not even profitable, there's a high amount of risk associated with that investment. Because they're not listed on the major exchange, whether they're on like the New York Stock Exchange or the NASDAQ Exchange, listed stocks, which are those stocks, are easy to sell because there's generally always a buyer when you're looking to sell. With these, because they're not listed on a major exchange, there's less people actively trading them, so they can be difficult to sell, especially if you have a lot of shares of that stock. So maybe you made an investment, you're up, and you can't get rid of those shares because nobody's looking to buy them. So that's something else you have to consider with penny stocks as well. This is the biggest reason, guys, is there's a lot of scammers out there when it comes to penny stocks. One of the biggest is called the pump and dump scheme. I talked about this in another video. I can't remember off the top of my head which one it was. But this is basically where you'll have somebody send a newsletter around and it says, this is the next hot penny stock. Now, before they send that email, these people bought a huge position in that stock, okay? And then they go and they send this email around, or they make these videos and they basically inflate that stock. And they tell everyone, oh, this is the stock to buy. This is the hot penny stock. Then what happens is that stock price goes up as other people buy it. When that stock price gets to a level that they're comfortable with, they sell out and they just leave everybody else with this stock that's soon to crumble because there's nothing really supporting that stock price. So that's what's called a pump and dump scheme. There's a lot of other scams and schemes out there with penny stocks. So definitely do your research on those, even just out of curiosity, so you understand what's going on. But that's one of the main ones. The only people that I know that make money off penny stocks are people who actually short sell the pump and dump schemes. I know one of these people is Tim Sykes. I don't know if you guys follow him at all. I've never really looked into his strategy, but from what I know, basically he short sells pump and dump schemes. So when he sees a stock that's way up and he can tell it's being inflated, he'll short sell that stock and take money from the falling stock price on that. So I know him and some of the people that invest with his strategy have made a good amount of money in penny stocks, but it's not in the conventional way of buying them low and selling them high. It's short selling, which is much more complicated. They're not an investment for beginners, and unfortunately there's a lot of people out there that are pushing these on new investors. And I understand the idea behind it. You say, oh, okay, well, I don't want to buy a stock that's $100 a share. I can buy a stock that's a couple dollars a share, and it's a much safer investment. Stock price has nothing to do with how safe an investment is. If it's a cheap stock, if it's an expensive stock, that has nothing to do with the company itself for the most part. And people look at it as, oh, okay, it's a $2 stock. Why don't I buy 1,000 shares instead of buying, let's see, if there's a $100 share stock, instead of having 20 shares of that stock, I'd rather have 1,000 shares of a $2 stock, because that way I feel like I have more of it. And it's just a bad strategy that people have. Another reason is because they're very difficult to find credible information on penny stocks, because they're not actually required to file with the Securities and Exchange Commission. So it's hard to find good information on these companies because there's so much that they're not required to actually disclose. In my opinion, new investors should avoid penny stocks at all costs. If you're looking to invest in the stock market and just play around, just find a couple of dividend stocks, maybe like Coca-Cola or Disney or something like that. There's a lot of these stocks that people would buy like for their kids because they're just these stable companies that have been around for a long time, and they don't really do much. There's not a ton of volatility with them, but it can be fun for you and give you that first step in there, watching stock charts and learning about investing. I would say do that over investing in penny stocks. So if you have anybody telling you to invest in these, even if you've heard of people having luck with them, guys, it's like lightning striking twice in some cases. I don't know a lot of people who one after another have luck with penny stocks. What happens in most cases with people I've talked to, they'll invest in a penny stock and then they'll win money. They'll win a ton of money on that bet, and then they end up investing in other penny stocks thinking they could do it again, and they lose all that money. I don't know a lot of people who consistently take profits. I don't know anybody who has consistently taken profits from penny stock investments in that way. But that's pretty much it, guys. Those are the 5 main reasons people lose money in the stock market. So if you're looking to get into the stock market and you're considering doing any of these 5 things, try to avoid these at all costs. And like I said, if you know anybody who says, oh, the stock market is a losing game, you're going to lose your money, ask them what they actually did when they invested. How did they decide to invest in the stock? If they did any of these 5 things, maybe that's why they didn't have success with the stock market. But that's pretty much all I got for this video, guys. If you have any topics you want me to cover in other videos, make sure you drop me a comment below. And if you guys are interested in my own stock market trading guide, I do have my beginner's guide on stock market trading. I will link up to that in the description, and there should be something popping up here on the screen as well.